The return of goods and bad debts are two areas that are related to the sales system. Recall the auditor's big worry is that the client will overstate revenue and assets. When the accounts receivable allowance is not properly estimated, the net realizable value may in fact be overstated. Don't allow the sales personnel or accounts receivable personnel to approve bad debt write-offs. The accounts receivable personnel has the responsibility of recording the transactions. Don't also allow them to authorize the write-offs. Credit memos should be used to authorize returns. Know that credit memos are used to authorize customer returns, and debit memos are required to authorize the return of items purchased from suppliers or vendors. Credit memos are part of the sales system, and debit memos are part of the purchasing system. There are 7 major departments in the typical purchasing system. 1. User departments who desire to purchase equipment or goods for the company. 2. The actual purchasing department. 3. The receiving department who receives the goods. 4. The warehouse, the same warehouse discussed in the sales system. 5. The accounts payable, also known as vouchers payable area, the group that matches or agrees the purchase order information with the receiving report with the vendor invoice to verify agreement. 6. General accounting, that posts the summary transactions to the overall general ledger. And 7. The treasurer's department, who signs and mails the checks. Note that the accounts payable department is a very key department in the purchasing process. Accounts payable authorize the vendor invoice to be paid only after completion of the matching, a check of the vendor invoice's mathematical accuracy, and coding the invoice to the proper account number. Be sure to see that when you are working the multiple choice questions dealing with accounts payable, that they are conducting the most effective internal control procedure to prevent paying for goods not received, not ordered, or for overpayment of goods. The matching process is a very powerful technique used to help prevent or detect material misstatements in the accounts payable area. Accounts payable also maintains the accounts payable subsidiary ledger. The necessary controls for the accounts payable purchases area are as follows. Users authorize purchases via purchase requisitions. The budget is checked before the purchase request is approved. Separate purchasing department prepares the purchase order. Purchasing examines past vendor history for quality. Purchasing obtains competitive bids or pricing. Receiving counts the goods, inspects for quality and damage, files proper damage reports, a debit memo, if a problem occurs. Receiving reports and receiving logs are used. No goods can be received without a copy of a purchase order. Receiving department's purchase order has the quantity ordered blocked out. Accounts payable matches the purchase order, receiving report, and vendor invoice information. Vendor statements are reconciled monthly in the accounts payable department to the voucher payable listing. 2 signatures are required on large checks. Checks are locked up securely along with signature stamps. Checks signed by treasurer while examining the voucher packet. Invoices are canceled, marked paid when the check is signed. The person who signs the check last also mails the check. Voided checks should be retained and the signature portion ripped off. Bank reconciliations should be performed or reviewed by the internal auditors. If we add the manufacture of inventory to the above purchasing system, keep in mind the purchasing department, accounts payable, and inventory functions would not change. You would simply add a managerial function to cost the goods and a quality control area to inspect the completed goods for quality before storage in the warehouse and eventual sale to a customer. The necessary controls for a production cycle include: maintain a perpetual rather than a periodic inventory system. Utilize a standard costing system. Maintain custody of not only finished goods, but also work in process and raw materials. And reconcile plant job time tickets, the amount of time charged to each production function, to time cards showing the total hours worked. Require the use of a materials requisition form to move raw materials from the warehouse to the production floor. Remember, all forms should be pre-numbered for all systems, and periodically a supervisor should account for the missing form numbers and investigate how and when the transactions were recorded. Just pre-numbering documents is not sufficient control. The follow-up about missing numbers is very important. The personnel and payroll areas are also frequently tested. What's important here? The auditor is concerned about the existence of employees. Do all employees actually exist? Are they being paid only for hours and time worked? And have all transactions been complete in both recording the subsequent follow-up? A separate personnel department should authorize all new hires, pay rate changes, and benefit changes. The payroll department's job is to compute the gross pay and net pay based upon signed authorization forms for all deductions. Insist that all employees who handle cash are bonded through the use of a reputable fidelity bonding insurance company. Bonding key employees serves not only as a preventative to keep a company from hiring a former embezzler, but bonding also serves as a deterrent to help prevent employees from turning dishonest. They know an insurance company will investigate. The key controls in the personnel and payroll area are as follows. Segregate duties of hiring, firing, and promotions, that's personnel, from paycheck preparation, that's payroll, and distribution, that's the users and operating departments. Utilize time clocks or scanning devices for tracking hours worked. Reconcile job time tickets to time cards. The treasurer should sign the checks and deliver them to the appropriate operating departments for distribution to the employees. Encourage direct deposit. Return unclaimed wages to the treasurer's department for cancellation and reissuance to be deposited in a special bank account. Use a separate payroll account, impressed, IMPREST, for payroll transactions. Use a general account for other payments, such as for goods and services. Watch for internal control questions that test the direction in which an auditor should conduct a particular test. When an auditor is testing for existence, the auditor should select the test items from the end of the cycle, such as the ledger, journal, or register, and then go back to the necessary supporting documents. When an auditor is testing for completeness, the auditor would not select the test item from the ledger, since the auditor suspects that the item never even got recorded. For completeness testing, select your items from the source documents and move forward through the system to see if the transaction did in fact get recorded. Typical source documents include the shipping advice or bill of lading for the sales system, the receiving report for the purchases system, and the time card or timesheet for the payroll system. Remember a simple rule: existence tests from the end, completeness tests from the beginning. The rest of this CD is devoted to various auditor communications about internal control related matters. The first area of concern is that of reportable conditions. A reportable condition is defined as a significant deficiency in the design or operation of the internal control process that could adversely affect the client's ability to summarize, record, process, and report financial information. Recall, the auditor's primary control concern is about financial data. An auditor does not spend time understanding the non-financial controls and systems unless the auditor plans to use the non-financial information in performing his or her audit procedures. What many professors refer to as internal control weaknesses is actually internal control reportable conditions. Please use the term reportable conditions. Auditors are required to communicate reportable conditions to the audit committee. The communication may be verbal or in writing. An example of a reportable condition would be lack of segregation of duties, lack of reviews and approvals, lack of two signatures on large checks, lack of evidence to support the recorded transactions. Auditors do not search for reportable conditions. Rather, they identify them as they are performing their routine audit procedures. When auditors identify reportable conditions, they may report them immediately, group them and report later, or wait until the end of the audit. Just make sure the communication is completed before the end of the audit. Once a reportable condition has been communicated, the auditor is not required to re-communicate until there has been a change in management or the audit committee or a considerable passage of time. Some reportable conditions are also classified as material weaknesses. The definition of a material weakness is a reportable condition that is of such magnitude that the design or operation of one or more of the internal control components does not reduce to a relatively low level the risk that material misstatements caused by error or fraud may occur and not be detected on a timely basis within the normal course of performing their assigned function. All material weaknesses are reportable conditions. Not all reportable conditions are material weaknesses. The auditor may communicate the material weaknesses in the same report along with the reportable conditions, or the auditor may communicate the material weaknesses in a separate report. While an auditor is not allowed to issue a report stating no reportable conditions were noted, an auditor is allowed to issue a report that lists the reportable conditions and then says, none of these reportable conditions are deemed to be material weaknesses. The timing of the report is like the report of reportable conditions. The auditor may communicate the material weaknesses when they are found, group them together and then communicate, or communicate upon the conclusion of the audit. The decision as to whether an interim communication should be issued is influenced by the relative significance and the urgency of the corrective action. When a client refuses to correct the significant deficiencies or reportable conditions, the auditor simply assesses control risk at maximum. Do not modify the standard audit report as a result of uncorrected reportable conditions. Remember, the auditor is auditing the financial statements, not the internal controls. Reporting on internal control is known as attesting or providing an opinion on the entity's internal controls. Please consult the back of the Wiley Audit Text, Module 2, for a discussion of this engagement type. Be sure your text is no older than 1 year from the exam date you are sitting for, as this area is presently being revised by the AICPA.